Did any of us ever think we'd see the Tokyo market completely shatter the 65,000 barrier? Well, it just happened. And a sudden massive 6% plunge in global oil prices literally lit the fuse for this truly historic rally.
65,158. That's the new unprecedented reality for the Japanese market. Hello everyone, welcome back to AI Market News. Today we're breaking down the extraordinary domino effect that led to this milestone and what it all means for all of us moving forward.
Section 1. The global oil plunge. Let's start with the primary catalyst for all of this week's remarkable market action, which is advancing US-Iran peace talks.
Looking at the sharp drop here, the graph shows New York crude futures plummeting to around $90 a barrel during Asian trading. According to current market information, this sudden drop of roughly 6% was triggered by strong signals of progress in peace negotiations. While a final agreement could take a few more days, just the prospect of an end to the conflict immediately repriced the energy markets.
For beginners, let's briefly look at the underlying mechanism here. When oil gets cheaper, it costs less to manufacture and transport goods. This eases energy cost, which in turn cools down inflation pressures. And when inflation drops, it allows long-term interest rates to fall, ultimately making stocks a much more attractive investment for all of us.
Section 2. Nikkei's historic milestone. This brings us to how this global domino effect landed squarely on the Japanese market, creating a perfect environment for domestic equities.
This momentum is clearly reflected here, as the graph shows the Nikkei surging a massive 1,819 points, or 2.87%. This incredible upward trend allowed the index to close at a historic 65,158, firmly crossing that 65,000 line for the very first time in history.
This historic charge was led aggressively by AI and semiconductor names. SoftBank Group hit a new all-time high, pushing its market cap above 40 trillion yen, while Fujikura hit its daily limit up price, the maximum daily surge allowed by the exchange. The reason why is quite clear. High-growth technology and semiconductor companies benefit the most when inflation expectations drop and long-term yields dip, because it makes their future earnings far more valuable today.
Section 3. U.S. equities and treasuries. Tracking this momentum across the Pacific to Wall Street, we see a similarly strong picture, keeping in mind that U.S. markets are closed today in observance of the Memorial Day holiday.
Tracking Friday's close, the graph shows the S&P 500 S&P 500 gaining 0.37% to close at 7,473. This marks its 8th consecutive weekly advance, the longest winning streak we've seen since December 2023. The Dow and NASDAQ also edged up, with the Dow adding 294 points to settle within striking distance of its own all-time high.
However, the bond market is telling a slightly more cautious story. The graph shows the U.S. 10-year Treasury yield remaining stubbornly elevated at 4.56%. To understand this underlying dynamic, bond yields stay high when investors anticipate that the central bank might keep borrowing costs high rather than cutting them. This reflects underlying concerns that the fight against inflation isn't completely resolved just yet.
Section 4. Currency dynamics and Fed. This tension in the bond market brings us to the tug-of-war currently dictating the strength of the US dollar against the yen. Based on available data, Federal Reserve Governor Christopher Waller delivered a hawkish reality check in Frankfurt. He suggested the Fed should drop its easing bias and warned that rate hikes literally cannot be ruled out if inflation doesn't improve. This shocked markets, pushing the probability of a December rate hike up to roughly 43%, all happening just as new Fed Chair Kevin Warsh takes the helm. This Fed pivot had an immediate impact on currency pairs, bringing us to the 159.1 level. The USDJPY briefly dipped into the 158 range on Friday due to dollar selling tied to the optimistic oil news, but Waller's hawkish talk drove the dollar right back up to the 159.1 range. The mechanism here is simple. Higher interest rates in the US attract global capital seeking better returns. This increases demand for the dollar and drives its value up against the yen.
Section 5. Upcoming economic indicators. Finally, let's pivot to the economic calendar to see what will drive market momentum next for all of us.
Looking ahead, with all times stated in Japan Standard Time, Thursday night is absolutely the critical juncture. The U.S. will release its Q1 GDP revision and the April PCE core deflator, which is the Fed's preferred inflation gauge. Following Waller's recent warnings, this inflation data will dictate rate expectations and is highly likely to trigger our market's next major move.
So the question now is, will the inflation data finally cool down the Fed, or are we bracing for another hawkish shockwave?
Thanks for watching. Please subscribe and hit the like button. This video is automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.